are all aware of the devastating global economic impacts of the COVID-19 pandemic. Sweeping its way into 2021, COVID-19 affected most of the economies of the world, with Britain's economy being one of the most adversely affected economies. At this point, most of you will be wondering, how long will it take for the UK economy to stabilize, or at least return to a pre-pandemic state? Well, here are some facts about the UK economy and the recent developments by the Bank of England to speed up the economic recovery. Welcome to the Wealth Lab, and thanks for checking in. During 2020, the economy of the United Kingdom shrank by an all-time low of 9.9%. With the lockdown restrictions, unemployment, shutting down of businesses, reduced demand, and slow economic growth in the last quarter, the economy had a narrow escape from a double-dip recession. In comparison to other European Union counterparts, the UK's economy had performed the worst. One of the reasons for this decline during the pandemic is that the country's economy is very much focused on services, hospitality, and customer services that were affected considerably during the last year. The economy is expected to start with a slow-paced growth by spring of 2021. However, the Bank of England has warned people to prepare for negative interest rates. The state of the UK economy. Some blame the UK's failing economic state on Brexit and Boris Johnson because pre-pandemic, the UK economic growth wasn't very promising. The economy grew at a relatively slower pace, and the pandemic came as a massive threat to the system. The UK's economy is one of the worst-hit economies by the pandemic and is expected to observe a rapid rebound during the latter half of 2021. Economies like that of the UK are highly dependent on the services sector, which will take a while to catch pace. During 2020, in the first quarter, the economy shrunk by 2.9% and 19% in the second quarter. In the third quarter, with lockdown restrictions being slightly lifted, there was a record growth of 16.1%, which came as a promising sign. The ongoing vaccination programs will possibly allow the economy to return to normal, but according to an expert economist, the economy might not return to pre-pandemic levels till March 2022. Even though the economic shock the country has been through during the pandemic will dissipate, the crisis may result in prolonged damage and structural shifts in the overall economy. Enjoying this video so far? Remember to hit that subscribe and like button. Okay, let's get back to the video. The pandemic has significantly affected public finances. The expenditure of the government is increasing with the ongoing pandemic, and tax revenues are falling. The UK government budget deficit is likely to reach a peacetime record by the end of 2021. In the wake of the pandemic, the government has taken several steps to support businesses, workers, and household incomes. This extra expenditure will put up an additional burden of $280 billion during the government's current year. The longer the pandemic lasts, the longer the economy will take to return to normal. As the economy recovers slowly, the government's budget deficit will decrease, tax revenues will restore, and the extra expenditure to support individuals, workers, and businesses will decrease. Bank of England's role in the economic recovery process. The Bank of England, or BOE, is one of the oldest banks in the country. Being established in 1694, it is the central bank of the United Kingdom and has served as a model for many modern banks today. In February 2021, for the first time in 327 years, the Bank of England has warned banks and building society across the country to be prepared for the possibility of introducing negative interest rates. The news has caused a certain discomfort among UK residents. Imposing negative interest rates sounds like paying taxes on bank deposits, unlike the standard practice of getting interest on the deposits. Negative interest rates on saving accounts have a fair chance of eroding savings instead of actually increasing them. But what exactly do negative interest rates mean, and how can they affect the economy? What does it mean to have negative interest rates? The Bank of England isn't the first to introduce negative interest rates. Imposing negative interest rates has been a popular trend among the global markets since the Great Recession in 2008. However, until recently, the Bank of England has somehow managed to keep the positive interest rates. Since the start of 2021, there have been speculations about the BOE considering imposing negative interest rates. But what are the negative interest rates, and how would they affect the investors in the country? The Bank of England, being the central bank of the country, is intending to keep the money in the real economy and encourage more spending. The bank's main intention to fight this current scenario is to speed up money flowing out of the banks and into the economy. For this purpose, the Bank of England has been thinking about introducing negative interest rates. The central bank of any country decides the base interest rate to other commercial banks on their deposits. Their base interest rate being negative means that instead of receiving interest on the deposited amount, the commercial banks now have to pay to keep their money within the central bank. The idea does seem very strange and certainly makes the whole point of having savings less attractive. But the motive behind introducing the negative interest rates is to encourage the country's commercial banks to take out their deposit from the central bank and lend it to businesses and individuals for investment purposes. Such a step would ultimately stimulate the growth of the economy. How will negative interest rates affect the banks? Regarding the introduction of negative interest rates, there will be those who benefit and many who will face the loss. But one sector that will most likely have many problems with this policy is commercial banks operating in the country. Traditionally, the only way banks make money is by borrowing money at a lower interest rate and then lending it out at a higher rate. The money borrowed by banks is in the form of customer deposits, including high street customers, saving and current accounts, and longer-term bonds. When the banks have to pay to keep their deposits with the central bank, they are likely to pass it to the customers. The customers have to pay to keep the money within the banks, which will ultimately encourage saving money under a mattress rather than depositing in the banks. The introduction of negative interest rates would highly disrupt the traditional banking model, but banks being dependent on customers' money to stay in accounts would make them struggle with charging customers a negative interest. Commercial banks will be the most affected in this situation. Previously, the interest rates on bank accounts with the BOE have already been low, and in some cases, it was even zero. The falling interest rates have had banks in a difficult situation, but the introduction of a negative interest on deposits will only worsen them. Enjoying this video so far? Remember to hit that subscribe and like button. Okay, let's get back to the video. The negative interest rates impact on investors. Some say that the failure to introduce a negative interest rate would be a sign of the UK's economic downfall. Similarly, with the introduction of negative rates, many investors can make the choice that would further put the UK's economy in a bad place. During times like these, there is not a single piece of advice that works for all. It comes down to one's personal opinions and speculations about how much the interest levels can negatively go. It is likely for investors to move out their investments to another country or another currency to shelter themselves from the worst. Will households be affected? Interest rates of the saving accounts plunged to an all-time low since the start of the pandemic. However, introducing a negative interest rate is likely to cause more accounts to pay 0% interest or a little more, making the value of deposits low. While most banks are still silent on the matter, HSBC has already clarified that a lower interest rate would compel them to introduce a certain amount of fees on its accounts. Not to worry too much though. In case of the rates on personal loans and credit cards, the negative rates will not be increased, as they are typically fixed at the time you take them out. According to Andrew Bailey, the governor of the Bank of England, the negative interest rates will not affect the individual households, as it's just used as part of the bank's toolkit. Negative interest rate will affect commercial banks' balances. However, the interest rates on mortgages, overdrafts, and credit cards would remain positive. Still, introducing negative interest rates would be a massive step after exhausting all other options for economic recovery. But the question remains the same. Will all these steps help revive the pandemic-struck economy? Economic experts think that interest rates below zero would not boost the economy, as the lenders will most likely increase the mortgage cost as a response. The BOE hasn't yet formally announced the negative rates, and only time will tell if this new policy will be imposed to avoid the UK's economic fallout. What do you think? Leave your thoughts in the comment section below, and until then, I'll see you in the next video.